You're essentially pushing the tax bill down the road. It's not a one and done. You can continue to roll that tax bill down, down, down until you leave this earth.
One of the hardest and fastest rules of a 1031 exchange is a hard deadline. The policy that we want to grow the economy is more important than our rule that we want to collect taxes on capital gains. All those gains that have gone up and up and up and up, all wiped out, nobody's paying capital gains taxes on it. It's a very powerful tool in your toolkit.
Have you ever wondered how to sell a property without having a massive tax bill? In this episode, we're going to be talking about 1031 tax exchanges.
And today's guest is Sarah Petcher, real estate attorney and qualified intermediary who started her own 1031 exchange company during COVID. She's going to give us all the ins and outs that every agent should know to make sure that they have a successful 1031 exchange for themselves or for their clients and save thousands in tax dollars. All right, Sarah, thank you so much for coming. Before we get started on the meat and potatoes about what a 1031 exchange is, we wanted to start off and hear from you. If you have a tale of caution of where you've gone through a 1031 exchange, an agent was involved, and they probably weren't as experienced or had as much knowledge as they should have, and maybe things went south that you're willing to share with us?
Yeah, I'd be happy to. I've two, really. The first one is the agent that gives us a call saying, hey, I remember you did a presentation. I have a client who closed yesterday on the sale of their investment property, and they want to do a 1031 exchange because they're facing significant capital gains taxes. And unfortunately, I have to give them the bad news that it's too late at that point. And so in the cautionary tale in there is really two things. First, they've set themselves up with the client because they brought up a 1031 exchange, gave the client hope that they would be able to defer capital gains taxes. And then now they have to go back and say to the client, well, you know what? I didn't actually know enough to tell you correctly what to do. And so they make themselves look doubly bad, if for lack of a better word. It would have been better if they hadn't mentioned it at all. So the cautionary tale is, well, we can move pretty quickly, but we have to move before settlement. The other one is folks who know a little more about 1031 exchange, and they know just enough to be sort of dangerous. And so they tell their clients, oh, yeah, don't worry about it. You can buy first. And I had an agent do that. They told their client on a sort of $200,000 condo, you can buy first and sell later, right? Which in our world is called a reverse exchange. And that's perfectly feasible, but they're super expensive. They're very complicated. And usually on a $200,000 condo, it's not going to be worth their while. So the agents got their clients' hope up that they could buy this replacement property. But after we've had a conversation with the clients, like, well, I'm paying you almost as much as the capital gains taxes I'm trying to avoid because of the price point of the property. So again, because of the lack of knowledge, the agent sets themselves up to disappoint their clients. They set their clients up for disappointment. So I think for me, the cautionary tale in all this is if you have an investor client, set up a time to go talk to a QI. Don't advise your client yourself about the timing and what's involved in it. So, set up a conversation. You can participate in the conversation with the qualified intermediary, but be the connector. Don't be the provider of the information.
Yeah. Yep, I agree with that. I think lots of agents fall short there, and they think they're inspectors, they think they're insurance providers, they think they're 1031 facilitators, and then they get themselves in trouble where you're right. Our job is to know enough to be able to connect them to the right people to get them where they need to be, not be the jack of all trades. It's going to screw it.
For sure. So we're talking about 1031 tax exchanges, right? And some people that are listening have heard of it. If you've been in the industry, you may have heard of it. And then other agents, that might be brand new. I didn't know about it until I got into the investing world. So Sarah, if you can give like the layman's term, maybe like a concise explanation. I know we're going to do a deep dive on it, but in maybe 1 to 2 minutes, what is a 1031 tax exchange?
So it's a process by which you sell an investment property. So it's a property you have to have held for investment purposes. And to its core, you sell an investment property and you buy a replacement property that's also an investment, and you do it under the tax code section 1031, which is why it's called a 1031 exchange. And by doing it a certain way, following certain set of rules, the IRS essentially allows you to defer paying capital gains taxes on the sale of your replacement property. So, if you bought a property 20 years ago, you bought it for $50,000, you're now selling it for $500,000. As you know, for investment properties, you pay capital gains. I mean, you could deduct some things, but in general, you pay capital gains on the increase in the value of the property, right, or from your tax basis. And so, in a scenario like that, where you go from $50,000 to $500,000, that's quite a bit of capital gains taxes. Well, the IRS said if you sell an investment property and you buy a replacement property, then we will allow you to defer paying those capital gain taxes, meaning you're not paying them during this transaction. And that allows you to gives you a lot more buying power to buy a replacement property, because all of a sudden you're not paying, 50, 60, $100,000 in capital gains taxes to the IRS. You could reinvest that amount and buy a bigger replacement property.
Okay. And so you're essentially pushing the tax bill down the road, but what seasoned investors do is they essentially, if they then sell that $500,000 property, they kind of keep rolling it because it's not a one and done. You can continue to roll that tax bill down until you leave this earth. And then at that point, I think there's like a secret there that maybe we'll talk about later. Like,
yeah, we can talk about that later. But yeah, so essentially, I mean, as you can imagine, that's a very simple sort of structure of it. Now, as you can imagine, the IRS is in the business of collecting taxes, not letting you off for paying taxes. So, part of what we're going to talk to about today is all the rules they put around this process to make sure it complies with the way they're going to give you a pass for now on paying those capital gains taxes.
Sarah, before we actually go into the rules and all the speculations and things that the IRS makes the 1031 tax code, I'd love to know why. In your opinion, why would the IRS even allow an investor to do such a thing?
I think it's a great question, Nico. I think it's a great question because look, I don't have a crystal ball. I've never spoken to anybody at the IRS that was around in 1901 when it was started. But here's my understanding of it. The federal government in general looks at the real estate landscape, the real estate business, as a major engine for the economy. And in their minds, they say, well, if Anna is an investor and she's selling this property and she's buying another property, that's money flowing through the system. That's money that's growing the economy. And therefore, in the policy that we want to grow the economy is more important than our rule that we want to collect taxes on capital gains for this purpose, so long, again, as you follow all these rules that they have out, right?
Yeah. So essentially you're reinvesting into the economy. You're selling a property, but you're putting that money right back. All your proceeds are going right back into investing in the real estate in our country. So that's why they're open to you doing that, and essentially like a loophole.
Right. That's exactly right.
Okay. All right. So I know we chatted a little bit. We already talked about like agents' big misses here is they call you after the transaction has closed, or they didn't call you. They had someone buy a property first before selling. And then again, timing is off. Is there one other thing that you could point to? Like, what is a big miss that you've seen an agent do that's like, is it really just timing, or is there another big one that you're like, oh my God, I see agents do this all the time and I wish they wouldn't?
I mean, it's a very good question, but timing is so important in these transactions. I think I would also advise you, an agent wasn't involved in this one, it was just crazy investor. But because timing is so important, there's a lot of investors who look at foreclosures, for example, foreclosure sales to buy distressed properties, or who want to buy new construction completely on the other side of the spectrum. But all these transactions that have deadlines that are not within your control are potentially troublesome for 1031 exchange, because one of the hardest and fastest rules of a 1031 exchange is that the deadline is a hard deadline. And so if you don't identify a property in time, if you don't close on purchasing the replacement property, you're essentially paying your capital gains taxes, right? And you've let that money sit in somebody else's account for however many months that's been sitting in the account. So I think you just have to be cautious when you're an agent and you represent investors in an exchange. You have to make sure that the properties they're buying on the buy side are not properties that have sort of potentially troublesome states, right? So, for example, we had one in Maryland. We had he's a wonderful investor. He's completely crazy. He only buys replacement properties from foreclosure, from foreclosures. He's in the DMV area. And so when you buy a foreclosed property in Virginia, that works fine because it's a very quick process. But in Maryland, there's a right of appeal. And so he did 3 exchanges back to back, and one of them failed because the owner of the property who got foreclosed upon filed an appeal, and he had a deadline, and the appeal deadline came and went, and the settlement date came and went, in the 180 days came and went. So you just have to be very careful in those types of transactions.
So, Sarah, I'd love to talk about timeline, and we'll talk about rules and timeline after that. But speaking specifically to like the agents, when do you think it's a good time to bring up such a thing? Like when they're working with an investor client and they're thinking about selling, like, is it before they go active on the market, or?
I think if you know you're about to take a listing that's an investment property, I think the time to have that conversation is at the time you're sitting down with the client and having a conversation about you taking the listing. Saying, hey, is this an investment property? I think that should become part of your script, right? Unless it's clearly a primary residence. But if it's not clearly a primary residence, then you should ask. And hey, is this an investment property? And if so, have you heard about a 1031 exchange? And then at that point, connect them with a qualified intermediary, whether it's us or somebody else, it doesn't matter. You should, at that point, have them have a conversation with a QI, and you be part of the conversation also, so that we can look at all the things that are happening as part of this transaction. First of all, to make sure that it's eligible for a 1031 exchange. And then so everybody understands the many rules that go into successfully doing a 1031 exchange, including the timing, because the agent has to be part of that timing. The other thing to keep in mind is that if you're the agent on the sale, right? So it's a local person to your marketplace, wherever that is, but the client is buying a replacement property in a different jurisdiction, right? So then let's say they're selling in DC, but they're buying in California. Then the agent in California also has to be part of the conversation about the 1031 exchange, because the deadlines affect both transactions, right? So I think having those conversations up front so that the client can then contact his CPA, contact the QI, have a conversation, get some education. And then when you go to the market, you go live, you're under contract. At that point, you call the QI when you're under contract, and you pick up the phone and you say, hey, Sarah, I'm under contract. What's the next step? And then we'll actually start the process of the exchange.
Who are agent? Sorry, Anna. One last thing. So those who are agents probably understand the concept of deadlines because they wrote offers with contingencies and things like that. So having that conversation up front, like Sarah mentioned, just saying, hey, is this an investment property? What did you buy it for when you bought it 20 years ago? Kind of explaining the process. So those of you who are agents kind of listening, that could give you a leg up on some of the competitions if they're interviewing multiple agents, you can bring up this strategy that can help them save thousands, sometimes $100,000 in taxes down the road. So I'll let Anna kind of jump back in.
No,
But
my
it's
question is it's related. It's related. So obviously, I agree. I think regardless of what the equity difference is, like between when they bought it and what they're selling it for, showing your expertise is important. It makes you different. But is there a certain dollar amount where 1031 makes an exchange makes sense? Because, or is it all the time? Is it like, I mean, if you bought it and only went up 50K in value, like,
I mean, look, it's 50K in value. Your capital gains taxes is going to be what, between 20 and 25, 30%, depending on where you live. Because, there's federal capital gains taxes, there's your state capital gains taxes. So, is it worth it? I don't know. I mean, the fees are usually around our fees are just under $1,000. Most people are around $1,000. So then after that, you have a conversation with your CPA, right? And then you did make a determination. Maybe you have a lot of losses that you haven't harvested that you can harvest for that particular year. Each fact pattern is different. And I think that question it really highlights the fact that the most important thing you can have is have a conversation early, have your client have a conversation early with a QI and a CPA to make sure that we have had we know the full landscape and that we can give advice that's targeted precisely to their situation.
okay, that makes sense, because that's where it's different with residential properties. You have or like if it's your personal living property, you have that 250K or $500,000 capital gains threshold if you're married or single. So that's where it's different. For an investment property, it's a conversation you should have every time with all your trusted advisors to see if it's the right move.
Every time.
okay.
Okay.
So Sarah, we talked about like guidelines and things like that, but I'd love to talk specifically about these rules. Essentially, the IRS gives us in this text 1031 exchange code. I think we briefly talked about the 45-day window and the 180-day window. Can you kind of explain that? Like if we were speaking to a client or an investor, what that looked like?
Yeah. So I think before we start talking about timelines, if you don't mind, Nico, I'm gonna talk about whether a property qualifies for a 1031 exchange, because there's no point getting to the timeline if the property doesn't qualify.
Of course.
So I think 1031 exchange is it's a code section, and the code section provides for two different kinds of properties to be able to be part of an exchange. Those are real property that is held for investment or in business or in trade, right? So, and 99% of your situations are going to be properties that are held for investment, right? So, Anna and Nico buy a house together and renovate it and they rent it out. And you fast forward 8 years later, and now they've depreciated it, the market has shifted. However, they want to diversify. I don't know. For some reason, they want to sell their rental property. So they put it on the market and they do they want to do a 1031 exchange. So does it qualify? Well, they've held it for investment, right? So they've received market rent on it. We often get that question when properties are being sold or being purchased for kids to live in, right? And we get a lot of questions about, hey, my kid's going to college in Alabama, and I want to buy a condo for them to live in it. And my answer is, well, if you're charging them fair market rent and you have a lease, then all good. But if not, you're not holding it for investment purposes, right? Same thing. If it's been vacant for 2 years or 3 years, then we have to have a more in-depth conversation as to whether it qualifies as an investment property. For those of you who are on this podcast who, like Nico, you buy real estate, you renovate, and you flip, even though you may have huge gains in the value of that property because of the work you put in, that's not eligible for a 1031 exchange because that's held to be a dealer property. You being dealt with as if you're a dealer of real estate, and so not eligible for a 1031 exchange. So the first inquiry is whether it's a property that's been held for investment. And it has to have been held for investment or for business for a certain number of years. It would be really nice if the IRS gave us a hard deadline, but they don't. There's no hard and fast rule. So, depending on how risk adverse you find yourself, I am super risk adverse, so I recommend that you've held it for at least 2 years. You'll see some QIs out there who say, no, one tax cycle you found one return showing income on the property, that's good enough. That's your client's risk pattern or your affinity for risk. But we recommend that you've held it as an investment for 2 years prior to selling.
Okay. And correct me if I'm wrong. What I heard is fix and flips, people that do remodels and plan to resell it do not qualify, right?
That's correct. Do not qualify.
If they're going to sell it, because you're not meeting that 2-year window. But if you were doing a fix and flip and
That's
things
correct.
go south and you don't sell it and end up converting it into there's ways around it. But that's why you should talk to somebody to see about the circumstances.
Yeah. And you talked about the type of properties like these. Like you're selling a property, you can buy a bigger property or another multifamily. You mind talking about like the type of properties that do qualify?
So this is a sort of the nice, but the only sort of easy part of this rule is that in the eyes of the IRS, real estate is real estate, right? So if Nico owns a parking garage in Hawaii and he wants to sell that for a condo at the beach in Delaware, that is perfectly fine. That's real estate for real estate. You can even sell, not that this is going to happen to you guys, but you can sell leases, you can sell easements, you can buy leases, you can buy easements. So it really is an interest in real estate. The only sort of subtlety about this is that it only is within the 50 United States. So you can't do an exchange in and out of Puerto Rico. And Guam and the Mariana Islands have some additional residency requirements. So they're much harder to do. But if you're within one of the 50 states or the District of Columbia, you could do an exchange.
Good to know. I'd love to circle back about the 45 and 180 days. Now that we know kind of what qualifies, what type of properties, real estate for real estate, what are those rules that the IRS put in place for it to actually make sense and you're able to defer those capital gains?
So these are the real pain points in transactions. Let me start by saying that. So the rule is you have 45 days from the date of settlement on the sale of what's called your relinquished property, your investment property that you've owned for a while, your relinquished property. You have 45 days from the date of settlement on the sale of that property to provide your QI, your qualified intermediary, an identification of a replacement property. And for us, an identification is just a piece of paper we'll send you that you can sign, identify replacement properties. And I think we might go into the rules for these identification rules in a minute, but it's essentially a piece of paper. So you've got 45 days to give me that piece of paper that identifies the real estate you're going to replace. So it can be an address, it can be a tax ID number, a parcel number, depending on what you have. Most of the time, we just get an address, and that's perfectly fine. The second clock that's ticking at the same time as that 45-day clock is ticking, again, from the date of settlement on the sale of your relinquished property, starts another clock that runs at the same time as the 45-day, which is a 180-day clock. That 180-day clock is the number of days you have to close on the purchase of the replacement property. And of course, because it's the IRS, I'm going to add a little twist, which is that if that timeline straddles a tax year, right? If it straddles January 1st date, you have to file an extension for your taxes because the identification and the closing, that 180-day period, has to happen over the same tax cycle. So you need to file an extension. So the whole transaction makes it onto your tax return. If it's broken up into two tax returns, it doesn't work. It's 180 days. And so if you, with a good QI, and let's say you sell your property in November, right? End of November of any given year, and any good QI will send you an email reminding you that you have to file for an extension for filing of your tax returns so that you don't get your 180 days cut off at April 15th, but you get the benefit of the full 180 days.
For anyone that's listening that missed it earlier, a QI is a qualified intermediary. I want to make sure I'm saying that correctly. Okay.
Yeah, qualified intermediary. Those are companies that are designated by the IRS code to be the ones who take your money at settlement. And maybe, Nico, this is a good time to introduce one of the golden rules of 1031 exchanges is that you, the investor, is not allowed to touch your money. You're not allowed to have any control over your money. So if you go to settlement on the sale of your relinquished property, all the proceeds will get wired to our trust account as your QIs. They get wired to our trust account, and it will be put in a sub account. For us, at least, it'll be put a sub account tagged to your name. You have access to, you don't have access to move the money around, but you have view access to your account during the time that we hold it. And then we will wire those funds at the settlement of the purchase of the replacement property. But one of the key factors is you can't have control over the funds. And that brings us back to your original question, Anna, why, I said one of the most oftentimes I see agents getting themselves into a little bit of a sticky situation with these exchanges is because they call me the day after they've gone to settlement. And that 1031 exchange fails because you failed that control test. Because even if you tell me, oh, but the funds are still with the title company. Oh, that's great. I'm great. But if you call the title company and you say, hey, I want the funds wired XYZ, the title company is going to wire it. It's going to follow your directions and wire them there, right? So that means you have control over the funds. Whereas if you call me, once I have the funds and you call me and you tell me, hey, I want the funds wired XYZ account, I will tell you, no, you cannot. The only ways I disperse those funds is if to a title company, because I have a contract showing that you're entitled to the funds to close, you need the funds to close, or if the exchange has failed and you're actually going to, pay your taxes at the right end of the right period, I will wire the funds directly to you. But that means the exchange has failed. So I have guidelines as to how I can dispose of the funds. And those guidelines is what allows a successful exchange because you, the client, the investor, no longer has control over the funds. I have control over the funds.
Got it. So I wanted to circle back, for an agent that's working with an investor, just representing themselves, right? They followed the steps that you mentioned, Sarah. They're like, okay, this is our game plan. We're going to sell this property. We're going to do a 1031 exchange. And then we're talking about timeline, right? So we're getting ready to close. We got the clear to close from the buyer of our relinquished property, and we're getting close to settlement, right? You mentioned that 45-day rule. So they have to send you a piece of paper that says, these are the 3 properties that I'm looking to purchase, correct? And then after that, if you're in a competitive market like Anna and I are, what does that look like if they don't purchase those 3 properties that they put on that list?
Yeah, it's a great question, Nico. So I think that it's one of the easiest things. And I think each QI is going to be a little different. So let me start by saying that. All you need to do is tell me I'm revoking the prior identification. And as long as you're within that same 45 days, you can send me another piece of paper with another 3 addresses, right? And you can keep doing that as long as you're within the 45-day period, right? If you're really having a hard time buying real estate. And I've had clients who have really hard time buying real estate. We have a client right now who's trying to buy in the Outer Banks, and they get into bidding wars and they keep losing out. And so he's making an offer on his 7th property right now, right? So it accounts for that as long as that gets done within the 45 days. Because, if 45 day comes and let's say on day 46, you give me a call and you say, well, the last of those three properties is that I had identified, I can't buy. Can I send you a replacement? And my answer is going to be, no, we're outside of the 45 days. And the worst thing about this is that the rules require me to hold on to your funds because you've identified properties in the 45-day period. There is still a crazy chance you might be able to purchase one of them. So I have to hold on to your funds until the day 180. And on day 181, I can wire you the funds, even though you're not doing a 1031 exchange.
Okay. So for like a pro tip for those who are listening that are agents that are doing this, yes, you can identify three and you can, continuously do this a few different times. But when you're getting towards the end of that window, you really need to make sure that you're picking three that you realistically think that you can close on, whether that's getting under contract within that 45 days, or, even if it's after, making sure that you actually plan on closing on one of these properties, because that deadline is very strict. So that's why I like working with an agent like Anna and I, who get access to maybe off-market deals that, not everybody is seeing. You can possibly close on those properties. That could be a benefit as well.
Yes. So in case people
So-
miss it. Oh, sorry. Go ahead,
Sorry.
Sarah. Go ahead.
No, I was just going to say, Nico, we keep talking about the three property rule, but there's, and I don't think we need to get into more details, but there's three rules that govern identification of property. That three property rule is the most common one we will see with residential real estate agents. The other ones, which is the 95% rule or the 200% rule, I mean, I can spend time explaining it to you, but I don't think it's worth our time. I think you're going to see them so seldomly that that's sort of a waste of your brain space for this particular crowd.
Okay.
Got it.
All right. And so whenever you are a real estate attorney, or an attorney that focuses on real estate and knows a lot about real estate, but in case people missed it, you're also a QI. That was something that, if I remember correctly, was a COVID, like over COVID, you're like, I need to do something else. And this is kind of where the 1031 exchange company came to be. So could you walk us through, if an agent came to you and said, I have somebody that is interested in a 1031 exchange, they've never done one before, what would that process look like if they were walking this through with you as the QI? Kind of how would you explain things to them, because they've never done one before? And this will probably answer some of the questions about like what's a qualifying property. And
Yeah. So first I'll tell you that we lead with education. So that's what we do. We do that for our law firm. We do that for the 1031 exchange group. And so I will spend as much time as you need me to spend on the phone with you explaining a 1031 exchange process. And I'll do the same with your clients. And then and it's important because I can talk with an agent about the process in general, right? But I can talk with a client about the specifics of their transaction. And the important thing to remember about a 1031 exchange is that there are as many versions of an exchange as there are different of situations out there in the marketplace. So it's not a one size fit all. There's a lot of nuances that go into an exchange. And so my first step will be to talk with the agent and make sure that the agent is, because frankly, almost 100% of our referrals for these 1031 exchanges come from real estate agents. So my first job is to educate their real estate agent so that the real estate agent can take that education and deliver to the client an ad, right? An extra benefit, an extra layer of knowledge that other agents may not have. We also provide a cheat sheet, for lack of a better word, and we'll email you a cheat sheet so you have sort of the basic facts of an exchange, sort of the skeleton of an exchange, if you will. And then usually the agent by that point runs a little triage with their clients, trying to figure out if it qualifies or not. And if it qualifies, then we'll schedule a follow-up call with the clients and the agent. I always keep the agent looped into the conversation. First of all, so the agent learns, but second of all, so they're not surprised with anything, because there's a lot of paperwork that goes into doing a 1031 exchange. And the agent needs to be made part of it, because most forms library around the country, if you're going to do a 1031 exchange, you have to add a clause to your contract that allows for the assignment of the contract, both on the sale and the purchase, as part of a 1031 exchange. So the agent has to be part of the conversation, because that language has to be made part of the contract. And then after that, most of the community will ask for the agent for an introduction to the title company. And then after that part, once we have a copy of the contract and a communication with the title company, after that, we'll copy the agent, but 90% of the communication will go between us and the client for setting up all the paperwork, and then us and the title company for setting up all this title company needs to have in order to get the closing done smoothly and to wire the funds to us. Once you've gone to settlement, we'll get a letter. We can get a letter out to the client, so to show the amount of funds available to purchase one replacement or multiple replacement properties. And we'll start communicating. If you're the same agent for both properties, it will continue communicating with you. But if you're not, there's a different agent for the purchase of the replacement property, and then we'll start communicating with that agent and making sure they're set up and they give us an introduction to the next title company, and we can start pedaling all over again, doing all the other forms for the second transaction, and make sure the funds get there on time.
Okay. Did I miss it? Did you mention, like, is there any specifics on what qualifies as a property, like, for this list? Did I miss that?
So the list will have an investment property is any real estate that's been held for investment or in trade or in business, as we've discussed earlier today.
But there's a value, right? Like, it can't be, does it have to be more than what you're selling for? Isn't there like a value thing? Or no, it can be less?
I apologize. I'm sorry. I didn't understand your question. Yeah. Sorry. So the general rule of thumb is that, let's say Anna sells $100,000 property. You can make some deductions, but for purposes of the conversation, we're going to pretend there are no deductions. She has to buy one or more properties. So if she's buying one property, that property's got to be worth $100,000 or more. If she's buying multiple replacement properties, then the total value of those replacement properties has to equal $100,000 or more.
All right. For that next property, they can still take a loan now, right? It doesn't have to be a cash purchase on the next property.
That's correct. So that's interesting, because a lot of people get caught up on that. A lot of people say, well, I'm selling. So let's go back to Anna, who's selling her $100,000 property, and I do $100,000 because I can actually map the math live on $100,000. So Anna is selling her $100,000 property. Let's say she has a $50,000 mortgage that's getting paid off at settlement, right? A lot of people think, well, I only have $50,000 to reinvest, so I only have to buy $50,000 worth of real estate, right? And the answer is no. You have to buy $100,000 or more of real estate. And the reason for that, if you think back at when we started this conversation, the reason the IRS is giving you, or the federal government is giving you a pass or allowing you to defer those capital gains taxes, is because you're reinvesting money into the economy. And if you're reinvesting less, then you're not growing the economy. You're growing the economy if you're reinvesting the same or more, right? And kindly enough, the IRS doesn't care whether you make up the difference, right? Anna had $50,000 of mortgage. So in order for her to buy another $100,000 property, she either has to bring $50,000 of cash in addition to her $50,000 proceeds, or she's got to get a loan for $50,000. And the IRS doesn't care how you get to that $100,000. They just care that you do.
And they also don't care if you're buying multiple properties, as long as it's the equivalent of what you sold, right?
That's exactly right.
Okay. And I know that can get tricky because, we just talked about how hard it is to find one that does qualify, and getting one under contract and closing. And if you're closing on two, unless it's, a pocket listing or things like that, there's a lot of factors that could make that fail, right?
So I think, Nico, you had a pro tip. Let me give you another pro tip. If you have a client that is selling multiple properties to consolidate into one, or selling one to diversify into multiple properties, all fine. But you got to talk to me and we got to get our ducks in a row long before a 1-for-1 transaction, because those deadlines, they apply, right? If you're selling multiple property, the first one to go to closing is going to trigger that 45-day deadline, not the last one, the first one that goes to closing. So we really need to get our ducks in a row on that one, right? And if you're buying multiple property, it's the settlement on the last one that has to happen within the 180 days. So, right. So you just have to make sure it's perfectly feasible. I got clients doing it all the time. You just have to make sure you're very coordinated and very organized.
Yeah, that was actually going to be my next question is, in your expertise, how often are you seeing like the 1-for-3 or the 3-for-1? Or is it usually a 1-for-1?
Yeah, we see it pretty often. I would say about maybe a third of our transactions are either multiple for one or one for multiple. And it's usually different stages, right? The multiple for one are usually folks who are getting older and they don't want to manage, right? Multiple properties. They just want to get one bigger one and they just want to manage that. Or even they sell multiple properties and they reinvest in what's called a Delaware statutory trust, which is a real estate investment mechanism. And so they don't have to actively manage that anymore. And the folks who go from 1 to 3 are folks like you and Anna who are in growth mode, right? And they want to manage more properties. They want to, they want to invest in more real estate. And so they're selling one, leveraging that one to buy multiple.
Okay. So we talked about that. I mean, this takes a lot of planning, right? You want to talk to an agent that understands it. You want to talk to a qualified intermediate that understands it. But for an agent that's like listening, what are some questions when they're meeting with an investor? They say, hey, I want to sell this investment property. What are I know we talked about a few of them, but what are some things that they should probably ask the seller to ask them to see if this makes sense to them?
So I think some basic questions, and you got to be careful because you don't want to give them tax advice and you don't want to give them legal advice. And so that's really the very fine line you're walking, especially you're always walking it. When it's 1031 exchange, it's especially sort of tenuous line. So I think you have to ask them whether it's been rented out, right? Has it been held for investment? And then you should ask them questions that should trigger a conversation with their CPA. Like, have you fully depreciated the property? Do you have a lot of losses that you're going to be harvesting in this upcoming tax cycle? And then those questions should trigger a conversation with their CPAs to figure it out. Now, the tricky ones are the ones who don't have a CPA, who've been filing all their taxes by themselves, which is very laudable, and I am kudos to you. But it makes the 1031 exchange a lot more complicated because there's a whole bunch of analysis that the CPA has to do, right? A 1031 exchange is a three-legged tool. A successful exchange is a three-legged stool. It requires an agent, it requires a CPA, and it requires a qualified intermediary. Those are the three professionals that are sort of required for a smooth exchange, because really what the CPA needs to do is that they need to look at the past tax return at that particular property, and then they need to make a calculation for the client as to how much their actual capital gains taxes would be if they sold without doing a 1031 exchange, right? And then the client can make an informed decision as to whether they're going to do an exchange. So your job as an agent is to sort of prompt that conversation, remind them they have to have a conversation with their CPAs to ascertain that, connect them with a QI, make sure everybody gets educated, and then, ask questions about the property. Like, is there still a mortgage? Is there a balance? Is there a mortgage? What's the balance? And do you understand that if you do a 1031 exchange, you're going to have to replace that outstanding amount of the payoff with either cash or another mortgage, right? Because you got to buy equal or greater. I mean, those are sort of the simple things you can talk to them about. And all of them, our cheat sheet that we will send to a realtor is really geared towards a realtor so that they can help their clients in those transactions.
I may have to ask you to send me that cheat sheet for my files.
And Sarah, I think we hinted at this earlier, right? So the whole goal of this is not to not pay taxes, it's to defer, right? And to defer, and you can continue doing this, right? But what if somebody says, "Hey, when do I have to pay that, Sarah? Like, what happens when I need to pay all those taxes?" What would you say? Like, can you continue doing this, or?
Yeah. So the answer is if you don't want to pay any capital gains taxes, then you have to keep doing exchanges until you pass away. And for this purpose of this conversation, I'm going to have Anna get hit by a bus. So let's say Anna bought an original property for $100,000, right? She's done 1031 exchanges over the course of her life with that same property. The original property has gone bought once, sold 5 times. Okay. So at this point, she's deferred 5 sets of gains, right? On the 4 sets of gains on these transactions. If she calls me and says, "Hey, I'm done with managing real estate. I just want to sell this last one," my answer to her is going to be, "Oh no, you're not." Because not only do you have to pay capital gains taxes on this last one, you got to go and pay all the previous gains. So no, you're not. So you're going to do it. The goal here is to do 1031 exchanges until Anna gets hit by a bus. Anna's going to do 1031 exchanges until she gets hit by a bus. At the point at which she gets hit by a bus, then her heirs inherits that last property that she did a 1031 exchange with, right? That she purchased as an investment. And they're going to get what's called a stepped up basis. That means, in layman's term, it means all that past accumulated deferred capital gains that she hasn't paid taxes on is wiped out. So nobody ever pays the capital gains taxes on those transactions. So Anna bought a property 50 years ago that was worth $100,000. The property she owns at the time she passes is worth $2.5 million. All those gains that have gone up and up and up, all wiped out. Nobody's paying capital gains taxes on it. It's a very powerful tool in your toolkit.
My children better thank me.
So I've essentially defer until you pass away. You don't have to get hit by a bus
until
you pass away. Yeah. And that
That's
sounds
right.
morbid, but
well, I mean, they say, right, the only certain things are death and taxes. So there you go. 1031 exchange deals with both taxes.
That's the new catchphrase. You use death to avoid taxes.
There you go.
Well, that is why we wanted to have Sarah come on, explain how it's such a powerful tool that the 1031 exchange is. So for all the agents listening to understand and really, talk to Sarah and talk to QIs in your area to kind of understand how you can benefit if you're investing yourself or if you're working with investor clients, because a lot of these investor clients might not even know about it and they are okay with paying taxes. But if you come at them and explain this, or essentially have Sarah come in and explain it in better detail, it could really help them and really help you stand out as an agent.
And I think it's important to note that a QI, unlike our law firm that only practices in the DC, Maryland, Virginia area, a QI is a national company. So we can, if you're selling a property, let's say in DC, but you're buying in Hawaii, we can, any QI can help with any transaction as long as it qualifies as a 1031 exchange.
Okay. It's not like a law license. You have to have a bar. You have to pass the bar in each state. Here, you're across the board. Any of the 50 United States and DC.
Yeah. That's right. Although I will tell you that there are very few states that have state laws regulating QIs, and Virginia is one of them. So hiring a QI that's based out of Virginia is a good thing because we have fiduciary duties with your money that other QIs don't have necessarily. Not that they, just for your safety, it's an additional layer of protection for you so that, I don't go take a vacation in the Philippines with your money.
Mm-hmm. A country with no extradition laws.
That's right.
Well, thank you, Sarah. I mean, as you can see, there's a lot that goes into 1031s, and we just did a highlight in the last 50 minutes. But for those who want to know more and want to learn a little bit about QIs and Sarah and your team, where can they reach out to you?
They can reach out to us. The easiest way is by email, which is info at the THE 1031exchangegroup.com. That's the name of our company, the 1031 Exchange Group. So it's info at the 1031exchangegroup.com.
Perfect. And we'll make sure to put that in the show notes. But that is going to do it for another episode of the Agent to Investor podcast. Please like, share, subscribe, reach out to Sarah, and you can reach out to Anna or me. You can reach out to me at N Garcia Official on all social platforms. And you can reach out to Anna at
I'm Annabalic_realtor.
Thank you. Tune into the next one.
Thank you. Thanks, Sarah.
Thank you.